All right, guys, again, here's my second take. The first take didn't work, so you will see here that I was working on the problem. So let's go back to the notes. So um, what you're going to work on today, we worked on the bank reconciliation yesterday. Today, what we're going to talk about is the journal entries that need to be recorded based on that bank reconciliation. There are basically two things you need to know with bank reconciliation. Any debit or credit or any increase in cash or decrease in cash shown on the bank statement that we did not have in our company records needs to be journalized. So any finance charges, service charges, interest received, notes payable or notes receivable received, sorry. Those types of things need to be journalized. Also, if we find out that we recorded an entry incorrectly, the amount incorrectly, we need to journalize that so that there is the correct amount in that journal entry. So these are the two situations right here in which we need to do journal entries when we do the bank reconciliation. So going to practice exercise 8-3A on page 423, so turn to page 423. And then wherever you did it on your notebook paper, I guess. Okay, so the journal entries for practice exercise 8-3A. I've already did it because I thought I was recording myself and I wasn't. Way to go, me. Woohoo! So when you look at PE 8-3A, the balance per bank and balance per company records, we don't worry about because that's just the balance. So we don't have to worry about journal entry there. Next one, bank service charge. We don't know about the bank service charge until we get our bank statement, but that's a decrease in our cash, our company's cash. It's an automatic withdrawal by the bank that we pay them to have or use the bank services to have our account there. So we need to journalize that. As we look down, the deposit in transit. The deposit in transit is a deposit we've made but doesn't show up on the bank's statement. So it does show in our records, so we don't have to do anything with it because we've already recorded it. The NSF check. We may or may not get notification before the bank statement about an NSF check. If we don't, when we do the bank reconciliation process, NSF checks always, no matter when we receive the memo, always need to be journalized. NSF checks are this. A customer wrote our company a check. We deposited that customer's check, assuming that the funds were good. Our bank is now telling us that those funds are not good. There wasn't money in that checking account. So because of that, we have to decrease our cash because we don't have it. But now because that check wasn't good, that customer still owes us that amount of money. So we have to put it into that customer's accounts receivable account. So our entry is as follows. The debit for the bank service charge goes to miscellaneous expense for $50. The NSF check gets debited for $12.50 to accounts receivable because that customer owes us the money. Because those are the only two, cash then decreases by $1,300. The outstanding checks, we've already written the outstanding checks. The bank just hasn't paid them yet, so we don't have to do anything for journalizing the outstanding checks. So for the example in P 8-3A, this is what needs to be journalized. Now, just show some more options. We'll do the journal entries for 8-3B as well. Okay, so let me just get this set up. All right, so again, balance this 8-3B, balance per bank, balance per company records, we don't have to worry about. Bank service charge, we know we have to journalize that. So because that's an expense, we need to journalize it. And the bank service charge is $50. Once again, I'm just going to format these cells, $3. Okay. The next one, deposit in transit. The deposit in transit, again, are deposits that we've made that don't show up on the bank statement. Since we've already made them, we've recorded them, we don't have to do a journal entry of bank reconciliation. Next one, note collected by the bank with $450 interest. Okay, so the bank collected a note for us. So what we're going to do is deal with this a little bit differently. Okay, because the miscellaneous expense decreases cash, what we're going to do is record that as a separate transaction. We're going to record the note collected by the bank as a separate transaction as well. So that note that we collected, or the bank collected for us, increases our cash by the amount of the note and $450 in interest. So that total amount is $9,450. Because the bank collected that, we have earned some interest revenue, $450. Revenue increases on the credit side, so we credit interest revenue. And because it was a notes receivable, we need to credit our notes receivable by $9,000 because that is the amount we received. If we received that amount in the notes receivable, that means that we are no longer owed that note. So we have to decrease that asset account. Assets decrease on the credit side. So that's another example of journal entries. The reason I split these two is because one involved a decrease in cash, one involved an increase in cash. You could theoretically do both of these in one. You would have miscellaneous expense debited for 50 and cash then would decrease in this transaction by 50. So it would work itself out in that way. This makes it a little cleaner to do it in two separate transactions. That is all I have to show you for journal entries. So what I want you to do is to complete exercise 8-17, 8-19, and 8-20.